Hello, and welcome back to another episode with Sharp Education. Today, we're diving way deeper into bonds, which are an introductory unit to most finance courses because they are the foundation of what people use to assess risk. Risk is the name of the game when it comes to investment. What makes something grow is risk, necessarily. You need to take on the chance of it not growing in order to gain a reward. So risk is really everything in this game. And the bond market is what calculates those mathematically. If you can assign a numerical value to risk, you will find it in the bond market. I want to teach on how bonds change in value, but instead, for the purposes of this episode, where we will be making a trading strategy, I'm going to just do an introductory overview of bonds, and I encourage you to look into YouTube videos that do a better job than I can at explaining the relationship between supply and demand and interest rates. Here is a chart of what supply and demand for bonds looks like. When demand for bonds increases, that makes their price increase as well, which is the face value of these bonds. And when that increases, then the rate decreases. The interest rate is what people are more concerned about, which is how much they're making for not being allowed to touch their money. It's like debt. When you buy a bond, you are guaranteeing that you make a fixed percentage back, sometimes referred to as fixed income. This interest rate is effectively the risk people are willing to sell their money for, or the percentage they are willing to receive for the risk that they are taking on. Now, that opens up a whole can of worms for study that I'm not going to be taking you through. I highly encourage you to understand bond valuation like the back of your hand before getting into fundamental valuation of equities, because they're calculated including using the risk-free rate. That's part of the capital asset pricing model. What is the risk-free rate? There's a bunch of different definitions. People use it. It's sort of interchangeably, but for our purposes today, we are going to be calling it the 10-year treasury rate, like we have right here. The 10-year treasury rate, as we know based on my super quick overview, is the percentage people are willing to receive in order to give debt for 10 years. So if you buy a bond for $10,000, that means you are willing to make that rate for 10 years nonstop. So if the risk-free rate or the 10-year treasury rate is 4.2%, then that means that the risk-free rate, what you get with the guarantee that you are going to get that money back, is 4.2%. If there is any risk, if your investment is riskier than guaranteed that you will get it back at that rate, then the rate that you demand, what you necessarily are going to need in return, will be higher than that rate. And that's what you see in equities. Equities, like the S&P 500, have a higher rate of return, sometimes between 10 and 20% over the last 20 years, because there's more risk. Now, if you're risking a company going bankrupt throughout the duration of you holding stock in that company, then you should demand a higher rate of return to accommodate for that risk. And that's what the equities market is. Super cool. Now, the 10-year treasury, because it's backed by the central bank, will not default. You are guaranteed to get that back. You will get your money back. And the rate is usually very low, 4-point-something% right now. You can actually just look that up. 10-year treasury rate. And there we have it right here. It's 4.11%. So that means if you're guaranteed to get your money back, you're going to mandate 4.11% returns over the course of that time. That means that your money will grow at a specific rate that should outpace inflation. What you want is for the risk-free rate, or the rate at which you are lending money to somebody, to outpace inflation, or else that's a bad investment. That's a bad decision. You shouldn't have loaned money to them. You lost money. And now, if you're investing in the stock market, where your returns can be between 10 and 12% just for passively investing in a diversified index, that means that because of the extra risk you've taken on, you're outpacing inflation by way more most of the time, because there are also recessions that impact stock valuations heavily, but they do not impact the value of they do not impact the returns you will get from your bonds. You will always be returned 4% regardless of whether or not there's a crash, because it's backed again by the central bank. A really big can of worms that I've just opened up, and what I want to do is incorporate this into what I'm going to call one of our more effective trading strategies. Today, what I want to do is look at expectations. Inflation expectations are also something that you can get from looking solely at bond yields. How is this the case? Well, there's something called Treasury Inflation Protected Securities, which are also referred to as TIPS. And I'm 90% sure that is what the acronym stands for. I just always call them TIPS. Let's look at TIPS. Treasury Inflation Indexed Note Bond. And this is a 10-year Treasury Inflation Indexed bond, meaning that the yield you get will be indexed for inflation. Regardless of what inflation is, you will always get, relative to that, 1.3% returns. Now, you'll notice that's way lower than our 4.11%. So what does that mean? If the Treasury Inflation Indexed bond is 1.3%, and that's what the efficient market mandates the yield to be, because you can buy and sell bonds as often as you like in order to calibrate the yield at the price that the market deems to be, or at the rate that the market deems to be most representative. This is the byproduct of the efficient market. It's 1.303%. But our 10-year Treasury rate was 4.11. Interesting. So that means that the stock market is pricing in 2.8% inflation for the next 10 years, which again is higher than our target, which is around 2%, but only slightly. And that's interesting. So that means we have inflation expectations, what people are expecting inflation to be in the stock market. Now, if you were able to follow everything I just sort of rambled through haphazardly, now you know how inflation projections are calculated. You can have in conversations with somebody, oh, it looks like the market's looking at about 2.8% inflation over the next 10 years. They're expecting just a higher than anticipated or higher than normal level of inflation regardless of what happens. Wow, that's knowledgeable. If you can understand the relationship between TIPS and the same duration 10-year Treasury rate, which is generally referred to as a risk-free rate, that means you know a thing or two. So congrats for sticking around for that boring introduction to what is now going to become a trading strategy. I'm going to take the P10J30, the series IDs from these two pieces of information from Fred, and paste them into our code for VS Code. So let's switch back over to there. So I've made a file called expectations.ipynb. As you know, these code bases are always posted at the end of the episode, but I encourage you to follow along while we're doing it, because that is a good way of understanding where the errors usually come from. Let's go back to another Fred file and copy in all of our packages. And I'm going to take the first section of this code for now and paste that in as well. So now we're getting raw price information from Yahoo Finance, which is one API. We're also going to add our two new series IDs. So what I want to do is I want to add the risk-free rate, which is a super important number in finance. It's the bottom of most valuations. If the amount of money people would demand for risk-free providing debt increased drastically, that would mean inflation expectations are really high, meaning interest rates are going to change, the federal funds effective rate is going to change, meaning the value of holding equity is going to change. It is the foundation of it all, the risk-free rate. This is a really good thing to understand. What changes it? Why people are so connected to it? Look further into this. Watch a whole other YouTube video that explains it better than me. I highly recommend doing that. The series ID for that was, let me find it, DGS10. So we're going to call this in and call it risk-free. Now our second piece of information is going to be the Treasury Inflation Indexed Bond, or TIPS, yield on the same duration. So 10-year versus 10-year. There are also 5-year TIPS, 2-year TIPS, and those are short-term inflation expectations. which is more fun. You can do a lot with how they're interacting with short-term and long-term inflation expectations. But today we're keeping it as simple as I can in a subject that I get sort of into, as you can see. So we're going to paste in the series ID from Fred, DTP0010, whatever. We're going to get rid of the percent change, the year 1% change, because that's what we needed for inflation. But today, we are just going to be using the risk-free and the treasury inflation. So I'm going to call this tips. Now, let's make a plot with these two pieces of information. What I want to do is go to economy, and yeah, I will plot these two pieces of information here using a main function. Give me a second to write that. So I've written the main function here. Whoops. So I've written the main function here. We're going to run it, call it at the end here. And I'm going to be doing a plot of the risk-free rate and the treasury inflation protected securities. I do not want a plot of the price on the same thing, so I need to call a figure. plt.figure. This should be better. Wow. So the treasury inflation protected security information only goes back to 2020. So 5 years. Because if you look at Fred, you'll see that we're looking at a treasury inflation indexed bond due in 2030. So there's only 10 years of data. I'm going to see if I can find more information on 10-year treasury inflation indexed bonds. So we have effectively the same thing. We have an inflation indexed 10-year constant maturity quoted market yield on U.S. Treasury securities at 10-year constant maturity quoted on an investment basis inflation index. So data for DF inflation indexed 10. So I don't know what the DF is in this acronym, but you'll notice that if we go back to our code, that the series ID for risk-free rate is DGS10. Now we're going to put in DFII10 and run everything so our plot looks a little better, I hope. It does look a little bit better. Not spectacular, but we're just going to add the N here, drop NA, and try it again. Aha. Got to get rid of the NA values before the plot. Very interesting. Now, I'm going to make a legend. So now we have two pieces of information. The risk-free rate, which is what people are willing to lend money for with the guarantee that they will get it back at the rate that they are willing to get their money back at. So if you give $10,000 to somebody, you are willing to make $4,000 every year. So if you give $10,000 to somebody, that means throughout those 10 years, you're willing to make $400 every single year, if it's 4%. So you'll notice that's not a really big amount that they're getting back. It's a small amount. It's risk-free, though. So they're guaranteed to make those $400 every year. So that's appealing to some people. Now, inflected, treasury inflation protected makes the yield inflation indexed. And sometimes that actually goes negative. So when you're accounting for inflation on these 10-year treasury rates, your real return was actually less than zero. You lost some money because of inflation. So what people try to do is they try to price in what inflation is going to be based on all sorts of data. But the results of all of these analyses are just presented right here for you in the interest rates and the relationship that they have with inflation indexed interest rates. So let's find the inflation expectations. Inflation expectations is going to be this. Define, add inflation expectations to the data frame. Data frame expected inflation is going to equal data frame risk-free. I should be consistent here. Minus data frame tips. Return the data frame. And now we should have another column. And I'm going to add another plot. We're going to run that and see what we find. Add inflation expectations to the data frame, very important. And there we have it. Inflation expectations. Pretty cool. I think we can just find this exact chart on Fred. So let's look. So you see here that the final value of our inflation expectations is 2.28%. That's what people are expecting inflation to be over the next 10 years. I think it's going to be higher. That's my investment hypothesis. And I can use this to conduct investment research when I genuinely believe that the Federal Reserve is not, over the next 10 years going to be able to get inflation under control if this is how our economy is going to continue to look. I think we're going to see runaway inflation once again. That's my standpoint. And I might do more further research that proves me wrong. It doesn't matter. But right now, I'm going to be looking into opportunities that exist within the stock market that do exist based on my research. I think this seems like a relatively low thing to price in, but challenging the efficient market rarely works, but that's going to be my investment hypothesis. That's what I think is wrong, that inflation expectations should be higher. So let's go back to the Federal Reserve economic data base to make sure that we have calculated this inflation expectation correct. It looks like we have. As of the most recent date, the 10-year expected inflation is 2.287. But we're close because we're calculating it a slightly different way than the Federal Reserve does. And you can see our chart also looks different on the Federal Reserve as opposed to the one we calculated ourselves. But this is accurate. This is what we're looking at. Really, really cool. Now, we can build trading strategies based on inflation expectations because we also know how to bring in actual inflation and expectations. We're now using forward-looking information. This is what I always say on every single channel. You need to be looking at forward-looking information or you're behind because the stock market is a forward-looking entity. This is how you can see forward-looking information quantified numerically right for you. What are people looking at in the future is right here. Expectations. There is a numerical expectation. Now, this is already being priced in. This is forward numerical information. There is also retrospective numerical information, which is price action or any patterns that you can identify. And I'm going to take my moment to hate on technical analysis, ICT, SMC, everything rudimentary like that for just a second, because when people are looking at numbers like this, 2.28% expected inflation over the next 10 years, and other people are looking at, prices hit this key level of support and resistance, and I can draw a line here, and that means that the share prices are going to do this. That's not factored into this forward-looking information at all. We just looked at the 10-year Treasury rate and the Treasury inflation-protected securities rates, and at no point was the idea of where prices had been before that important. People are looking forward. They're pricing in. They're bringing that back to today, and they are not considering what happened yesterday or the day before that or 3 years ago or some pattern that they saw in 2008 that is going to come back again for the modern bubble. All stupid. You just got to look forward. You got to be using your windshield, not your rearview mirror, to invest. And this is how you can do it. I'm going to finish this episode up. Before we build a complete trading strategy on top of this, I feel like I've given you guys a little bit too much information, a little bit of an overload today. So for now, we're just going to stick with our ability to understand inflation expectations before building a trading strategy around them. And in the next episode, I will be completing this to see if we can compete with our investment hypothesis. Thanks for sticking around, and until next time, stay sharp.